Every trader fights two battles, one on the chart and one in their own mind. The first is visible, you can mark it, measure it, backtest it. The second is invisible, a war between discipline and impulse, patience and fear. And that's where most traders lose. Not because their setups are wrong, but because their reactions are. The market doesn't destroy them. Their emotions do. Jesse Livermore understood that long before the world even called it psychology. He built a system that didn't rely on prediction, it relied on precision. His legendary 80% win rate wasn't a myth. It was the outcome of a structure so disciplined that emotion had no room to interfere. His system stood on three foundations: trend confirmation, pyramiding into strength and risk to reward mastery. First, he only traded in confirmed directions. Livermore waited for the market to prove itself, not a hunch, not a guess, but a clear, tested move. If price wasn't confirming strength or weakness, he simply did nothing. That waiting game was his first weapon. He understood that missing an opportunity is cheaper than forcing a loss. The second foundation was his pyramiding method, the art of adding into a winning position, never averaging down into a losing one. He believed strength should be rewarded, weakness should be punished. Every add-on trade came only after the previous one moved in profit, reinforcing momentum rather than fighting it. This method multiplied returns while keeping risk under tight control. And the third foundation, the heart of his 80% strategy, was risk to reward engineering. Livermore structured every trade with a 3-to-1 ratio or better. He could lose twice and still end positive. His losses were small by design, but his winners were built to expand. That's how he turned mathematics into confidence. The edge wasn't about being right more often, it was about losing correctly and winning efficiently. Most traders today try to predict direction. Livermore focused on managing outcome. That mindset made him nearly unbeatable. His win rate didn't come from guessing the market, it came from aligning with it. And that's exactly why this system still beats emotional traders in 2026. Because no matter how advanced the tools get, markets still move through the same cycle of human behavior: greed, fear, impatience, and hope. Technology evolves, but emotion doesn't. Livermore's strategy was built to exploit that. He combined logic, structure, and patience into a single repeatable model that any trader could follow if they had the discipline to obey it. Yet most can't. They break rules in the heat of the moment. They chase, they hesitate, they overtrade. Livermore's difference was that he accepted boredom as part of mastery. He knew that no signal is worth emotional compromise. His capital only moved when logic and emotion were aligned. Never before. That's why his system worked like a machine. Every entry had to pass two filters: technical confirmation and psychological readiness. If either one failed, he stood down. His silence was his strategy. His restraint was his weapon. And his patience. That was his profit engine. The modern trader drowns in information, but Livermore thrived in clarity. He didn't need dozens of indicators. He needed conviction, structure, and timing. That's what created his legendary win rate, not predicting more but filtering more. By removing low-quality trades, he raised the quality of his results. That's the real secret behind the 80% win rate: fewer trades, higher standards, deeper conviction. He didn't win because he found more setups, he won because he only took the right ones. Every move he made was intentional, structured, and measurable, and even when he lost, his losses were surgical, small, controlled, expected. There was no panic, no revenge, no overreaction. Just a calm recalibration of probabilities. That's what made him timeless. This video isn't about glorifying Livermore. It's about learning his architecture of control. Because in trading, the battle isn't against the chart, it's against yourself. If you master that, you master the market. Livermore's system is proof that discipline outperforms prediction, control outlasts confidence, and structure always beats emotion. So as we dive deeper, remember this: the chart may evolve, but human nature doesn't. The trader who learns to control himself doesn't just survive the market, he commands it. And that's how an 80% win rate is truly built. Not through guessing the future, but through mastering your present. The foundation. Defining a winning trade. A winning trade isn't defined by green numbers flashing on your screen. It's defined by the discipline behind those numbers. Most traders measure success by profit, but professionals measure it by execution. A true winning trade is one that follows your plan, respects your risk, and aligns with your strategy, regardless of whether it ends green or red. Because in the long game, it's not the outcome that builds consistency, it's the process that does. Every great system stands on structure, and that structure begins with 4 unbreakable pillars: clarity of bias, defined risk, aligned momentum, and patience. Clarity of bias means you know exactly which side of the market you're on before you enter. You've done the work, analyzed the structure, identified trend direction, and committed to a thesis. There's no maybe long, maybe short. Indecision is a silent leak in your psychology. It drains your conviction before the trade even begins. A trader without clarity reacts, a trader with clarity executes. Defined risk before entry means you already know your exit before your entry. You don't place a trade to see what happens. You place it knowing what you'll do if it doesn't. That single habit separates disciplined traders from impulsive gamblers. Risk definition removes emotion from the moment price turns against you, because you've already accepted that loss as part of the system. There's no panic, no hesitation, no hope. Just execution. Aligned momentum confirmation is the third pillar. It's where your bias meets the market's proof. The setup might look perfect on paper, but if the price action doesn't confirm your bias through volume, structure, or momentum, you wait. That waiting is not weakness, it's control. Because traders don't get paid for early guesses, they get paid for precise entries. Momentum confirmation ensures that you're not fighting the flow, you're joining it. And the fourth pillar, patience, is the invisible thread that ties it all together. Most traders fail not because they lack knowledge, but because they can't wait. They jump too soon, exit too early, or move stops too fast. They treat the market like a slot machine, not a business. Patience isn't about sitting idle, it's about allowing structure to complete. It's the discipline to do nothing until your criteria align perfectly, and then having the courage to act when they do. When all four pillars align, you're no longer predicting, you're synchronizing. But here's where most traders collapse. They confuse control with over-analysis. They believe that adding more indicators, more opinions, or more data somehow gives them power. In reality, it builds paralysis. The illusion of control is one of the market's most dangerous traps. You start tweaking your charts endlessly, adding layers of confirmation that don't strengthen your plan. They just delay your decision. Over-analysis kills your win rate because it replaces confidence with doubt. The more you stare at the chart, the more your mind starts inventing reasons to hesitate. And hesitation in trading is costly, not just in money, but in mindset. You begin to chase perfection instead of precision. You want to be right instead of ready. That's when discipline starts to fade. The truth is, markets reward clarity, not complexity. You don't need to know everything, you just need to know what matters. Every high probability trade is born from synchronization between your plan, your psychology, and the market's rhythm. When those three are aligned, you stop trying to control the outcome and start aligning with probability. The irony is that the less you force the market, the more it rewards you, because the market doesn't owe you a win. It only mirrors your preparation. So redefine what a winning trade means. It's not the one that hits target, it's the one that was executed exactly as planned. The one that followed your bias, respected your stop, and let momentum do the work. Even if it ends in a small loss, it's still a win. Because you played your role perfectly. That's how consistency is built, not by chasing green trades, but by stacking correct ones. Every disciplined decision adds to your edge, even when the result doesn't. In the end, your goal as a trader isn't to predict where the price will go. It's to synchronize with how the market moves. The market doesn't reward prediction, it rewards patience, alignment, and control. When you master those, profit becomes a byproduct, not a pursuit. Because real success in trading comes from mastering the only thing you can control, your process. The market's rhythm changes, volatility shifts, and conditions evolve, but your structure should remain unshaken. That's the essence of professionalism: to trade your plan, not your emotions. So remember this mantra and make it your foundation. Process beats prediction, every single time. Timing the market like a sniper. Trading like a sniper isn't about pulling the trigger fast, it's about knowing exactly when not to. The market tempts you every second, flashing setups that look perfect but aren't yet ready. The average trader takes those shots out of fear of missing out. The professional waits, confirms, and then strikes when probability is on his side. Jesse Livermore called it sitting tight. In 2026 markets with algorithms, volatility bursts, and fake breakouts everywhere, this mindset has never been more relevant. The Sniper framework distills Livermore's timing philosophy into 4 deliberate stages: wait, confirm, strike, sit. Each word is a discipline. Together, they define precision-based trading. The kind that raises your win rate without needing more trades, just better ones. Wait. This is where most traders fail. They enter too early because they equate action with progress. But in reality, waiting is part of the trade. The sniper doesn't stare through the scope to fire instantly. He observes, tracks, and studies movement. He knows that every wasted bullet weakens his position. In trading, every impulsive entry weakens your statistics. The difference between a 40% and 80% win rate isn't in the system, it's in the restraint. Waiting filters noise from opportunity. It teaches you to see structure, not movement. You start recognizing how price traps emotional traders, retail traders jumping on every small move, while institutions quietly build their positions. The longer you can wait for confirmation, the more data the market gives you to confirm your bias. The moment you internalize that truth, your trading transforms from reactive to selective. Confirm. Confirmation is not prediction, it's alignment. You wait for the market to prove your thesis. A candle close beyond a key zone, a volume surge in your direction, or liquidity sweep that clears stops. These are confirmations, not guesses. Traders who fire early are gambling on hope. Traders who wait for confirmation are operating on evidence. Livermore used to say, "Be right and sit tight, but first, wait until it's right." That's the modern sniper's law. You let the market show its hand before you act. It's not fear. It's professional patience. And that patience is what stacks probability in your favor. Strike. When confirmation aligns with your bias and momentum supports your direction, that's when you act decisively. No hesitation, no second guessing. You strike with confidence because you've earned the right to. You've observed, analyzed, and confirmed. The sniper doesn't fire emotionally, he fires precisely. In trading, this means clean execution, proper position size, defined stop, clear take profit zones. Your decision should feel surgical, not rushed. The clarity of that moment separates skilled traders from spectators. The moment of execution should feel like the conclusion of a well-built argument, not a random impulse. Sit. This is the most overlooked phase of all. Most traders can wait, confirm, and even execute, but they can't sit. They interfere, move stops, take profits too early, and destroy the very edge they worked for. The sniper, after taking the shot, stays still to confirm the outcome. Livermore called this the art of doing nothing. Once you've aligned with structure, the market needs time to breathe. Your profit target is not an invitation to fidget, it's a probability zone that needs patience to reach. The ability to sit, to let the trade evolve without your emotional interference, is what multiplies returns. The more you trade, the more you'll realize that doing nothing is a position. Every adjustment without reason reduces your statistical advantage. Liquidity zones are the battlefield of this strategy. That's where emotions peak and precision wins. Most traders lose because they trade inside the noise. They see breakouts and chase them, unaware they're entering just as smart money is exiting. Liquidity zones exist where stop losses cluster, at obvious highs, lows, and structural levels. The sniper identifies these zones, waits for liquidity to get swept, and only then confirms entry in the opposite direction. This patience allows you to avoid being the prey. In Livermore's terms, the public buys the tip, the professional buys the turn. Emotional traders lose because they're reactive, patient traders win because they're selective. Volatility synchronization is another key concept in sniper timing. Every market has a rhythm: quiet consolidation, impulsive expansion, calm retracement. Most traders fail because they trade during the wrong rhythm. They try to force breakouts in quiet hours or chase reversals in violent expansions. Precision means synchronizing with volatility, trading only when the market's pulse aligns with your setup. You wait for momentum confirmation, volume alignment, and structural clarity before committing capital. This synchronization not only boosts your accuracy, but also keeps you emotionally balanced. When you trade in sync with volatility, the market feels readable, not chaotic. And when it feels readable, your confidence naturally rises, not from ego but from evidence. Then comes time filtering, one of the most overlooked yet powerful concepts. Not all market hours are created equal. 80% of profitable opportunities emerge during just 20% of trading hours. The rest is noise, traps, and whipsaws. The sniper understands this. He doesn't need to trade all day, he needs to trade the right hour. Learn your market's pulse. For intraday traders, the first 90 minutes after open and the first 30 minutes after key news events often produce cleanest moves. For swing traders, midweek sessions carry more weight than Mondays or Fridays. Time filtering isn't laziness, it's optimization. The best snipers don't shoot all day, they wait for windows of vulnerability. In markets, that window is when liquidity floods in, volatility aligns, and price action confirms your bias. Every other moment, patience is the trade. Here's a paradox that every great trader eventually discovers: not trading is a trade. Sitting on your hands when the setup isn't perfect is one of the hardest skills to master, but it's also the one that multiplies your accuracy. Every time you avoid a low-quality setup, you preserve both your capital and your confidence. You're not missing opportunity, you're protecting probability. The sniper framework isn't about speed, it's about sharpness. It trains your eye to filter noise, your mind to wait for alignment, and your hand to act only when the odds are stacked. When you internalize that sequence, wait, confirm, strike, sit, trading becomes peaceful. You stop chasing and start selecting. You begin to realize that consistency doesn't come from finding more setups, but from filtering them ruthlessly. In a world of traders obsessed with activity, the sniper wins through stillness. Livermore's principle remains timeless. The big money is not in the buying and selling, but in the waiting. In 2026, where speed dominates, the edge belongs to those who can still slow down, because the market never punishes patience. It rewards it in silence. Risk-reward, the mathematics of consistency. Most traders chase win rate like it's the holy grail. But here's the truth. You can win only 40% of your trades and still outperform someone who wins 80% of the time. The difference isn't accuracy, it's efficiency. Trading success isn't about being right more often. It's about earning more when you're right than you lose when you're wrong. That's where the real mathematics of consistency begins, the risk-to-reward ratio, or simply R to R. Jesse Livermore built his empire not by predicting every move, but by structuring his trades so that his losses were small and his wins were massive. He understood one timeless principle: markets reward asymmetry. Small losses, large wins. Think about it. If you risk $100 to make $300, you can be wrong twice and right once. And you still make money. That's the logic behind every professional trader's edge. A 1-to-3 ratio means you only need to be correct a third of the time to stay profitable. The real power isn't in being perfect, it's in being proportional. So let's break it down simply. Suppose your stop loss is 50 points away from your entry, and your target is 150 points away. That's a 1-to-3 risk-to-reward setup. It means for every 1 unit of risk, you aim to make 3 units of reward. That's how you turn probability into profit. Now imagine doing this across 100 trades. Even if you lose 6 out of 10, those 4 winners will more than cover your losses and grow your account steadily. But this logic only works if you control one key variable: position size. Most traders trade the same lot size on every setup, but professionals adjust it dynamically based on the distance of their stop loss. If the stop is wider, they use a smaller position. If it's tighter, they can afford to size slightly larger. The goal is to risk the same percentage of capital every single time. That's what keeps the curve of your account consistent instead of chaotic. Livermore's golden principle still applies today: never risk more than 1% of your total equity on a single trade. That means if your account size is $10,000, your maximum loss on any trade should not exceed $100. This simple rule protects you from emotional collapse, because even if you lose 10 trades in a row, you're only down 10%, not destroyed. You can recover, you can stay calm, you can keep thinking clearly. That's what professional survival looks like. But risk management isn't only about numbers, it's about psychology. Every trader, even the best, will face losing streaks. What matters is how you handle them. Most traders panic, cut their size randomly, or start revenge trading. Professionals don't. They understand that losing streaks are not a sign of failure. They're part of the statistical process. You can flip a coin that has a 60% chance of landing on heads and still get 5 tails in a row. That doesn't make the system broken, it just means probability takes time to express itself. The key is to stay consistent long enough for your edge to work. And that brings us to the heart of professional trading: expectancy. Expectancy is the formula that decides whether your system will make money or lose money over the long run. In simple English, it goes like this: expectancy equals your win percentage multiplied by your average win, minus your loss percentage multiplied by your average loss. So let's say you win 40% of your trades, and each win gives you $300. You lose 60% of your trades and each loss costs you $100. Plug that in: 40% times 300 equals 120. 60% times 100 equals 60. Subtract 60 from 120 and you get positive 60. That means that on average every trade you take, win or lose, earns you $60 over time. That's how professional traders think. They don't chase the next win, they play the long-term math. Every trade becomes just one sample in a larger data set. That mindset kills emotional attachment. You stop trying to be right and start trying to be consistent. Livermore mastered this philosophy a century ago. He said, "Losing money is the least of my troubles. A loss never bothers me after I take it. I forget it overnight." That wasn't arrogance. It was awareness. Because when your risk is predefined, a loss stops being personal. It's simply part of the system. And that's the real freedom in trading, detaching from the outcome. You no longer fear a red trade, because you know it's already priced into your plan. You focus on structure, not emotion. That's how you build longevity. The risk-to-reward model gives you permission to be wrong, often. You don't have to win every time, you just have to win efficiently. So from this moment on, stop asking, will this trade win? Start asking, is this trade worth the risk? That's the question every professional asks before clicking buy or sell. Because in the end, the market doesn't pay you for effort, it pays you for math. Protect first, profit second. That's how you turn randomness into consistency. You don't need to win often, you just need to win smart. Position sizing, the hidden lever. Position sizing is not about how much money you trade. It is about how precisely you control exposure when the market starts to move in your favor. This single concept decides whether you last in the market or vanish after a few bad trades. Livermore understood this perfectly. He knew that great traders don't start big, they grow big when the market confirms their direction. This is the essence of capital scaling. Adding size only when price action justifies it, not when emotions demand it. The amateur trader often falls into a dangerous pattern. They add to losing positions thinking they are lowering their average price. In reality, they are multiplying their risk and moving closer to disaster. Professionals do the opposite. They add to winning positions because the market has already proven them right. Adding to a winner compounds your advantage, averaging down compounds your error. This is the mental and mathematical divide between the professional and the emotional trader. Livermore followed a precise structure for scaling. He believed in a simple formula for safe growth: add only when the trade moves in your favor by a specific percentage, and keep total risk less than or equal to 2% of your total equity. For example, imagine your trading account has $10,000. Your maximum risk per trade is 1%, which equals $100. If you buy a stock at $50 and your stop loss is at 49, your risk per share is $1. That means you can buy 100 shares, because $100 divided by $1 per share equals 100 shares. Now suppose the trade moves in your favor and the stock price rises to $51.50. You decide to move your stop loss to $50.50. At this point, your unrealized profit equals your initial risk. You can now safely add another half position, for example, 50 more shares, without increasing your total exposure beyond 2% of your equity. This way, you are scaling into strength while controlling risk. The power of this approach lies in its logic. You are never adding to uncertainty, you are only expanding within confirmation. You are rewarding proven movement instead of predicting movement. This is why professional traders seem calm even when their size grows. They know that each layer of exposure is backed by market validation. Next comes the psychology of leverage, one of the most dangerous illusions in trading. Leverage makes traders feel powerful, but it also magnifies every mistake. Many traders confuse confidence with confirmation. They double their position because they feel sure, not because the market has confirmed. This is where discipline collapses. Professionals treat leverage as a privilege, not a shortcut. They use it to accelerate confirmed setups, not to gamble on hope. Livermore created a system called the layered exposure technique. It works like a pyramid, building strength as the market confirms direction. The first layer is the test position, small and controlled. The second layer is added only after the market moves favorably. The final layer is added when momentum becomes obvious. If the market reverses, the top layers are stopped out first, protecting the base position. This structure allows exponential growth with linear risk. In simple terms, Livermore scaled exposure with proof, not with prediction. He treated every trade like a campaign, strategic, deliberate, and defensively designed. If a trade lost, he lost small. If it won, he won big because his exposure grew with the trend. Let's look at this process in simple English mathematics. Total equity $10,000, maximum risk per trade 1% of total equity $100, position size risk per trade divided by risk per share if entry price of $50 and stop loss to $49, then risk per share to $1, position size $100 divided by $1, 100 shares if price moves to $51.50 and stop loss moves to $50.50. You can add 50 more shares without exceeding 2% total risk. This is how professionals manage scale without panic. Their size grows only when their safety grows. They never add while uncertain. They add when the market shows strength. Livermore once said that the biggest losses in trading come not from bad analysis but from bad position sizing. Most traders destroy profitable systems simply by risking too much too early. A good trader with a bad position size will eventually blow up, but a disciplined trader with controlled exposure can survive anything. Position sizing is not just a number. It is a mirror of your emotional control. The smaller your risk, the clearer your thinking. The clearer your thinking, the better your timing. And the better your timing, the faster your growth becomes. When you understand that position size itself is your real stop loss, your relationship with risk changes completely. Every percentage you risk is a measure of survival. Your goal is not to win big once, it is to stay long enough to let your edge compound. To summarize Livermore's hidden lever: add only when the market confirms your direction. Never exceed 2% of total equity in exposure. Build positions layer by layer. Cut losing trades early. Treat size as a tool for survival, not for excitement. The art of position sizing is the art of staying in the game. The market rewards those who control risk, not those who chase returns. In the end, it is not the biggest trader who wins. It is the one who lasts longest. Trade management and emotional neutrality. Trade management is where skill turns into mastery. Every trader can click a button to enter, but only the disciplined few know how to manage what happens after. The truth is, entries are overrated. What separates amateurs from professionals is not how they enter. It's how they respond once they're inside the trade. Once your position is open, your role changes. You are no longer a predictor. You are a manager. Your job now is to control execution, not outcome. Most traders don't understand this shift, and that's why they lose even when their analysis is right. A professional trader treats an open trade like a business project. You plan it, you manage it, and you close it based on data, not emotion. That's why management matters more than entry. The moment you hit buy or sell, the market stops caring about your opinion. From that moment on, your control lies only in how you handle risk, how you move your stop, and how you manage your psychology. Livermore understood this better than anyone. He used to say, "The big money is made by sitting, not thinking." That sitting wasn't laziness. It was discipline in letting a position mature until structure broke. The golden rule of management is simple. Let winners run till structure breaks, and cut losers when the plan invalidates. Every trade must have a predefined invalidation point, a price level or structural shift that proves your setup is no longer valid. You cut it there, no questions, no hesitation. Not because you fear losing, but because you respect probability. On the other hand, you let winners run not because of greed, but because momentum deserves time to mature. The longer you hold a valid trend, the higher your average return per trade. Here's the paradox. Traders who cut winners early and hold losers long believe they are managing risk. In truth, they are managing emotions. The fear of giving back profit and the denial of loss are the two emotional cancers that kill profitability. That's why the true edge is emotional neutrality, the ability to act without bias, regardless of whether your trade is green or red. To achieve this, professionals build emotional control systems. They don't rely on willpower, they use structure. The first system is the pre-trade breathing ritual. Before entering a trade, take 30 seconds to breathe deeply, slow down your pulse, and remind yourself, this is just one trade out of 1,000. That simple phrase instantly lowers emotional attachment. The second system is post-trade journaling. After closing a trade, win or lose, write down what you did right, what broke plan, and how you felt during execution. Over time, this builds awareness of patterns that sabotage you. The third system is limiting screen time after execution. Most traders ruin good trades by watching every tick, overreacting to noise. Professionals set alerts, walk away, and let the system do its job. Remember, once the trade is active, staring at the screen won't make it move faster. It only amplifies emotion. Detachment is not indifference. It's trust in your plan. The core principle of emotional neutrality is captured in one rule: you are not your trade. This is the foundation of psychological freedom. Your self-worth, intelligence, or confidence cannot depend on a single market outcome. If a trade wins, it doesn't mean you are a genius. If it loses, it doesn't mean you failed. It simply means one probability played out over another. When you internalize this, your entire trading experience changes. You stop chasing validation and start focusing on process. Emotional neutrality doesn't mean you feel nothing. It means you feel, but you don't act on it. You acknowledge fear and greed, but you don't let them guide your clicks. You replace emotion with structure. When you detach from the outcome, you begin to manage trades based on logic and structure, not noise. For example, if your stop-loss hits, you execute it automatically, not emotionally. You don't wait for, maybe it'll bounce. If your take-profit target is hit, but the market still holds structure, you scale out partially and let the rest ride. Professionals understand that management decisions compound over time. A small improvement in exit discipline can increase your equity curve more than any new strategy. Because the market will always reward consistency over brilliance. In the modern 2026 market environment, dominated by algorithms and rapid volatility, emotional neutrality has become even more valuable. The machines don't care about your feelings. They exploit them. Every impulsive decision, chasing, averaging, hesitating, feeds liquidity to algorithms that thrive on human emotion. That's why being calm is your hidden edge. To practice neutrality, build habits that reinforce logic. Start your trading session with a calm routine. Clean workspace, no noise, no rush. During the trade, stay objective, let data, not dopamine, dictate your action. After the trade, journal and review, not to judge yourself, but to refine your process. Over time, this rhythm creates a trader who is emotionally bulletproof. Livermore mastered this state. He wasn't emotionless. He was emotionally trained. He didn't fight the market or himself. He simply acted within his system, regardless of outcome. And that's what true professionals do. They understand that emotional neutrality is not a talent. It's a discipline built one trade at a time. Trade management, in the end, is the intersection of psychology and mathematics. It's where your rules protect your capital, and your mind protects your rules. The goal isn't to eliminate emotion. It's to prevent emotion from dictating execution. When you reach that level, your trading stops being a gamble and becomes a business. Your trades stop being emotional events and become statistical outcomes. That's when consistency begins, not from a perfect entry, but from a neutral mind. Market structure and confirmation. Every trade you take either flows with the market or fights against it. And this single choice decides your probability of success. Livermore called it the line of least resistance. It meant trading in the direction the market naturally wants to move, not where you want it to move. In today's markets, this concept translates into one clear rule: trade with flow, not against it. Price action, volume, and liquidity together form the pulse of the market. When you learn to read that pulse, you stop guessing and start aligning. Most traders fail not because they lack skill, but because they try to be first. They jump into trades before confirmation, mistaking early entries for smart anticipation. But the truth is, being early in trading is just another form of being wrong. Professionals wait for structure to reveal its hand before they commit. That's what Livermore meant when he said, "The path of least resistance is the one that pays." To understand structure, you must first understand how markets move. Every price chart is a reflection of collective psychology: fear, greed, and belief expressed in waves. The structure of these waves tells you whether buyers or sellers are in control. There are only three basic conditions the market can be in: uptrend, downtrend, or range. The job of the trader is to identify which one you're in and then act accordingly. The most fundamental signs of a healthy trend are higher highs and higher lows for an uptrend, and lower highs and lower lows for a downtrend. When the market continues to make these patterns, it's confirming strength. The moment the pattern breaks, for instance, when a higher low fails to hold, it signals potential exhaustion. But structure alone is not enough. You must also read volume, which represents conviction. A move without volume is like a promise without commitment. It may look strong, but it lacks substance. When price moves with increasing volume, it means the crowd agrees with the direction. The third element is liquidity. This is where traps are set and where emotional traders lose. Markets often sweep liquidity before reversing. That is, they take out obvious stop-loss levels before changing direction. Understanding this behavior protects you from becoming part of the liquidity pool. For example, when you see price breaking a previous high but volume doesn't confirm and momentum fades, it might be a liquidity grab, not a breakout. This is where patience pays. Avoid early entries. The best trades come not at the first breakout, but at the break, retest, reconfirm sequence. First, price breaks a key level, showing intent. Then it pulls back to retest that level, testing conviction. Finally, it reconfirms direction by rejecting that retest and continuing the move. That third step is your entry. This method filters out false breakouts and improves your probability dramatically. To simplify, there are three confirmations every professional trader seeks before execution: market context. What is the bigger trend? Are you trading with it or against it? Always identify the dominant direction on a higher time frame before acting on a smaller one. Price behavior. What pattern or structure is forming? Is it an impulsive move or a corrective pullback? Structure tells you the market's rhythm. Momentum agreement. Does volume, volatility, or any other strength indicator agree with your direction? If price is moving up but momentum is diverging, caution is necessary. When all three confirmations align, context, structure, and momentum, your probability of success multiplies. This is not luck, it's logic. One of Livermore's most overlooked principles is what modern traders call the second entry principle. It's one of the most psychologically difficult yet statistically powerful habits you can develop. The idea is simple: skip the first breakout and wait for the second. The first move is where impulsive traders jump in. The second is where smart traders confirm. The first breakout is emotion. The second is confirmation. By entering on the second entry, you let the market prove its strength twice, first by breaking structure, and second by rejecting a retest. For example, suppose the price breaks above resistance at $100. You wait. Instead of chasing, you watch as it pulls back to 99, tests that old resistance as new support, and holds. The next candle that confirms continuation, say a strong close back above 100, becomes your second entry. That's your trade. It's late enough to confirm, but early enough to capture momentum. Livermore built his 80% win rate philosophy on this principle: confirmation over prediction. Confirmation equals control. The more you wait for the market to prove itself, the less you rely on emotion. Impulsive traders think waiting means missing out. In reality, waiting is the highest form of discipline. It's how you filter noise from signal. Every confirmation you demand before entry reduces randomness. It's like asking the market to show ID before you let it in. Another way to think about structure and confirmation is through the metaphor of surfing. You don't create the wave, you read it. You don't paddle before it forms. You wait for the right swell, position yourself, and ride it once it proves strength. Trading works the same way. When you enter too early, you get wiped out by noise. When you align with structure, you glide with flow. To apply this practically in 2026 algorithm-driven markets, focus on the confluence zones, areas where multiple confirmations meet. For instance, a support level aligning with an uptrend structure, increasing volume, and a bullish retest. That's not coincidence, that's confirmation. The more factors align, the lower your risk and the higher your probability. Remember, confirmation doesn't eliminate losing trades. It simply makes your losses smaller and your wins cleaner. It shifts your mindset from guessing to waiting, from impulse to precision, from reaction to synchronization. This is the essence of Livermore's market structure philosophy: patience until proof. When you internalize this, trading becomes calmer. You stop caring about being right and start caring about being aligned. You realize that the market doesn't reward the smartest or the fastest, it rewards those who wait for clarity. Because clarity creates consistency, and consistency, not brilliance, is what sustains success in the long run. In the end, trading the line of least resistance means surrendering your ego to structure. You're not forcing your view onto the market. You're following its flow. You're not predicting direction. You're confirming alignment. Every confirmation you wait for is one step closer to control. Livermore's wisdom still echoes through modern charts. The market pays those who wait for proof, not those who demand to be right. Journaling, the trader's X-ray. No win rate is sustainable without data. You can have the sharpest strategy, the cleanest charts, and the most perfect psychology, but if you're not measuring your behavior, you're flying blind. This is where journaling comes in. Not as a diary of feelings, but as a precision tool for self-analysis. Every professional trader treats journaling as their X-ray machine. It reveals what the naked eye can't see: patterns of behavior, hidden biases, and the emotional cycles that quietly shape every decision. Livermore may not have had software or spreadsheets, but he had something more powerful: observation. He watched his trades like a scientist studying reactions. Every win and every loss carried data, and that data built discipline. Think of journaling not as something you do after trading, but as part of the trading process itself. It's your personal analytics system, the one that keeps you honest when the market tempts you to drift. Most traders ignore this step because it feels tedious, but that's exactly why it's powerful. Discipline lives in what most people avoid. Here's the truth: every losing streak, every missed opportunity, every emotional spiral leaves clues. Without a journal, those clues vanish. With it, you can see your trading for what it really is: a repeatable process or a pattern of emotional reactions. The journal becomes your mirror. What should you record? The essentials are simple but non-negotiable: entry, exit, reason, emotion, and market condition. Write down why you entered, where you exited, and what logic or setup justified that trade. Then record your emotional state at that time. Were you calm, rushed, hopeful, or fearful? Add the market context: trending, ranging, or volatile. This information connects cause to effect. Over time, you'll notice patterns that explain far more than the trades themselves. Screenshots of setups are another vital layer. Words can lie, visuals don't. By saving before and after images of your trades, you train your eye to recognize setups that work, and more importantly, those that don't. When you scroll through months of screenshots, you'll start to see the market repeating itself. The same patterns, the same traps, the same opportunities. What once felt random now becomes structured. That's the real purpose of journaling: to transform randomness into reproducibility. But the greatest benefit of journaling isn't just in documentation, it's in reflection. This is the principle of review over reaction. Instead of reacting emotionally to your mistakes, you review them analytically. You fix behavior before the market punishes you again. For example, let's say you notice that most of your losses happen in the first 15 minutes of market open. That's data. Instead of blaming volatility or bad luck, you adapt. You stop trading the open and focus on confirmed setups later in the session. One change like that can increase your profitability more than any new indicator. The beauty of journaling lies in its honesty. The market is always objective. It doesn't care about your opinion. A journal teaches you to be just as objective with yourself. You start to see that your biggest losses didn't come from bad analysis, but from emotional interference. You'll see that your best trades weren't lucky, they were structured, calm, and repeatable. Over time, this awareness builds trust, not in the market, but in your own discipline. To make journaling actionable, convert it into a data-driven decision system. Track your monthly expectancy, the formula that tells you your true profitability over time. Expectancy equals win percentage multiplied by average win minus loss percentage multiplied by average loss. In words, it measures what you can expect to earn or lose per trade. If your expectancy is positive, your system works. If it's negative, something needs adjustment. The goal is not to have a perfect win rate, but to have a positive expectancy curve. Next, use your journal to identify your highest probability conditions. You might discover that your best results come during specific market hours, volatility ranges, or asset classes. Maybe your setups perform best in trending markets and fail in choppy ones. This insight allows you to filter your trades, focusing only on environments where your edge shines brightest. Livermore mastered this instinctively. He traded only when the line of least resistance aligned with his conditions. Your journal helps you build that same intuition consciously. Another critical insight journaling provides is emotional correlation. For instance, you might find that your losing streaks start after a big winning day. Proof that overconfidence, not strategy, causes most drawdowns. Or maybe your performance drops when you skip sleep or overtrade. These are invisible factors you'd never notice without a record. Data exposes what emotion hides. To make journaling consistent, simplify the format. Use a table or spreadsheet with key columns: date, market condition, setup type, entry, stop, target, exit, result, RZR, emotion before, emotion after. Notes. After each week, review all trades and write a short summary: what worked, what didn't, what will I change next week. This reflection converts trading into a loop of continuous improvement. Plan, execute, review, adjust. The greatest traders in history, including Livermore, Wyckoff, and Darvas, all shared this habit of meticulous review. They weren't obsessed with predicting markets, they were obsessed with understanding themselves. The journal was their teacher. It doesn't just track your performance, it builds your identity as a professional. Because professionals measure everything. Journaling also reduces emotional weight. When you write your thoughts after a bad day, you externalize frustration. It's no longer trapped in your mind, influencing the next trade. You can see it, analyze it, and move on. Over time, you'll notice how your tone changes, from emotional venting to calm analysis. That's progress. That's emotional maturity through data. In a modern 2026 environment dominated by automation and speed, journaling gives human traders their advantage back. Machines can process numbers, but they can't process emotions. You can learn from them, adapt, and evolve. Each line in your journal becomes a fingerprint of growth. The paradox of journaling is this: it slows you down so you can go faster. It forces you to pause, reflect, and correct, so that in live markets, your reactions become automatic and precise. The journal is your feedback loop. The more detailed it is, the sharper your intuition becomes. In the end, journaling is not about remembering trades. It's about mastering yourself. Every data point you record, every mistake you dissect, every insight you uncover, they all build the trader you're becoming. Livermore's greatest edge wasn't timing or analysis, it was awareness. He knew himself better than the market did. And that's the power journaling gives you. When you document your process, emotion turns into evidence, randomness turns into rhythm, and trading stops being a guessing game. You start to see what the data has been trying to tell you all along, that consistency is not built on brilliance, but on awareness. Journaling is how you measure that awareness. It's your X-ray, your truth, and ultimately your roadmap to mastery. True mastery in trading begins when discipline becomes your default behavior, not something you force, but something you live by. Livermore's timeless discipline code isn't just about avoiding mistakes, it's about protecting your edge from your own impulses. Never average down. The market doesn't reward stubbornness, it punishes it. Never break your stop. The stop loss isn't a limitation, it's a life jacket that keeps you in the game. Never fight the trend. Momentum is the language of the market. Your job is to listen, not argue. Never let profits turn into losses. Secure partial gains, trail stops, and respect momentum shifts. Never chase missed moves. Opportunity is infinite, but capital is not. Every setup you skip with discipline brings you closer to mastery. Build your personal discipline script, a checklist you repeat before every trade. Is my risk defined? Is my mind calm? Is my setup confirmed? The truth is, consistency is built from boredom. Repetition turns rules into instinct, and instinct turns traders into professionals. Breaking one rule can erase months of progress. Discipline isn't restriction, it's freedom. Freedom from chaos, impulse, and the endless cycle of emotional trading. The best traders think slow but act fast, the paradox that defines professionalism. Every decision is made before the market even opens. Pre-plan your setups, define entry, stop, and target zones before the first candle forms. When the moment comes, execution should be automatic, not emotional. Use automation tools, alerts, and journaling software to reduce hesitation. Build habits that allow instant action on confirmed setups and total patience when nothing aligns. The truth is, traders don't need faster computers. They need slower minds and faster discipline. Precision is not speed, it's clarity under pressure. Every lesson leads to one truth: trading mastery is built on repetition of discipline. Wait, confirm, execute, manage, reflect. This is the trader's cycle of growth. The 80% win rate is never the goal, it's the byproduct of precision, patience, and preparation. Build your journal like a scientist. Define your risk like a commander. Respect your process like a ritual. Because in the end, trading isn't about beating the market, it's about mastering yourself within it. The calm mind wins, the patient hand endures, and self-control, that's the ultimate edge every real trader must earn.